Welcome to the Dakota Live podcast. I'm your host, Robert Morier. The goal of this podcast is to help you better know the people behind investment decisions. We introduce you to chief investment officers, manager research professionals, sales leaders, and other important players in the industry who will help you sell in between the lines and better understand the investment sales ecosystem. If you're not familiar with Dakota and their Dakota Live content, please check out dakota.com to learn more about their services. Before we get started, I need to read a brief disclosure. This content is provided for informational purposes and should not be relied upon as recommendations or advice about investing in securities. All investments involve risk and may lose money. Dakota does not guarantee the accuracy of any of the information provided by the speaker, who is not affiliated with Dakota. Not a solicitation, testimonial, or an endorsement by Dakota or its affiliates. Nothing herein is intended to indicate approval, support, or recommendation of the investment advisor or its supervised persons by Dakota. Today's episode is brought to you by Dakota Marketplace. Are you tired of constantly jumping between multiple databases and channels to find the right investment opportunities? Introducing Dakota Marketplace, the comprehensive institutional and intermediary database built by fundraisers for fundraisers. With Dakota Marketplace, you'll have access to all channels and asset classes in one place, saving you time and streamlining your fundraising process. Say goodbye to the frustration of searching through multiple databases and say hello to a seamless and efficient fundraising experience. Sign up now and see the difference Dakota Marketplace can make for you. Visit dakotamarketplace.com today. Tim, welcome back to the desk.
Good to be here.
Nice to see you. Tim Dolan of Dakota. It's always nice to have you on the desk. How's your summer treating you?
All is well. Hope the same for you.
Yeah, anywhere exciting?
Quite a few spots. Was just in Scotland with a few friends playing some golf, so no complaints there.
Oh, sounds like a difficult summer so far.
Exactly.
Doing well? Good. I'm happy to hear it. Well, I'm very excited to introduce you and our audience to our guest today, Frank Mihail, Chief Investment Officer at the North Dakota Department of Trust Lands. Frank, welcome to the show. Thanks for being here.
Thanks for having me, Rob.
Yeah, it's really a pleasure. We have a lot of questions to ask you, Frank. But before we do, I want to quickly share your background with our audience. So Frank joined the North Dakota Department of Trust Lands earlier this year as Chief Investment Officer, overseeing investments for the $7 billion Sovereign Wealth Fund. Based in Bismarck, the mission of the North Dakota Department of Trust Lands is to manage the assets of the permanent trusts in a manner that preserves the purchasing power of the fund and maintains stable distributions to fund beneficiaries, and to manage all other assets and programs entrusted to the board in a prudent and professional manner in accordance with the Constitution of North Dakota and applicable state law. The Land Board, which oversees the North Dakota Department of Trust Lands, manages 2.4 million mineral acres with interest in more than 8,600 of the 17,400 producing oil and gas wells in the state. The Land Board manages 13 permanent education trusts, including the Common Schools Trust Fund, the state's primary education trust fund, valued at more than $6 billion, which over the last decade has distributed more than $1.8 billion to K through 12 education. Prior to joining North Dakota, Frank was the Director of Risk Mitigation with the Public Employees Retirement Association of New Mexico. At New Mexico, Frank led core fixed income and absolute return hedge fund strategies for the $16 billion pension. Frank was also with Wedbush Securities out of California for 7 years, working in private wealth management. Frank received his BS in mechanical engineering from UC Santa Barbara and his MBA from UCLA Anderson School of Management. And I'd said before, he's our fourth UCLA Anderson School grad on the call, so we're very excited to have him. He is also a CFA and CAIA charter holder, and most importantly, Frank and his wife now call Bismarck home. Frank, thank you for being here, and congratulations on all your success.
Thanks, Rob. Appreciate it.
So how are you and your wife enjoying the Northern Great Plains?
It's beautiful. I moved up in January, and my wife skipped out on the winter and came up in the summer. But we've already spent some time driving through Montana and South Dakota. And Bismarck's a small town, about 130,000 people. So naturally, you get that friendly small town vibe from folks.
And I think you had mentioned before you're on the house hunt.
Yeah, that's right. We actually opened escrow on a townhouse, so expected to close here at the end of the month.
Oh, congratulations. Well, if it coincides with the release of the podcast, we'll make an announcement. Congratulations. It's not an easy time to be buying, so that's great news. I'm happy for you both. Well, one of the exciting aspects of what we do is getting to know why people choose the careers they do. But you started with a mechanical engineering degree. So what were your thoughts in terms of career path given where you are today?
Yeah, certainly took the scenic route to get where I am today. I come from a blue collar family. My dad was an immigrant from Greece. He worked the graveyard shift at General Motors at the factory line, and so he wasn't really one to give me guidance and be like, you should go to Wharton. In fact, I don't think I had heard of Wharton until I was in my 30s. So when I was in high school, I was good at math, and so I knew I wanted to go into a quantitative field. I was also into art and design, and wanted to, I thought car building would be cool. So that's how I ended up choosing mechanical engineering. And when I graduated, all the jobs were either in defense or oil and gas. And so when I came out of college, I worked in oil and gas for a little bit, and it just wasn't a fit. And at the time, real estate markets were taking off. This is like 2006. So I had my eyes glued to the real estate markets, and said, hey, I'd like to invest in real estate one day. I'm going to get my license so I can save on commissions, and I don't have to pay an agent a commission. I'll do it myself. And so by the time I got my license and made the transition, I had missed the top of the market. The music had stopped, and I became a real estate agent in Beverly Hills during the subprime crisis. And I did that for a while. I learned a lot about foreclosures and short sales and bank-owned REOs and apartment building investing. And I think one of the things you'll see is I've always had a continuous desire to keep learning. So from there, I wanted to just learn about other types of investments outside of real estate, and then that's what ended up leading me to transition into wealth management. Same sort of theme there. I was like, well, I want to invest in my 401k, and I want to know how to do it without paying financial advisory fees. So I'm going to go do it myself.
Seeing and hearing non-traditional journeys is one of the more interesting parts of the job, because we see people coming from all different directions when it comes to their seats. But you stayed in California and spent 7 years in private wealth, as you had mentioned. So could you tell us a bit about your time at Wedbush? So what were you learning? What was the focus on during that time, other than avoiding advisory fees from wealth management firms? We'd love to hear, what were those kind of formative years like for you before you made the step over to the pension fund?
Initially when I joined Wedbush, I had came on as sort of middle office, I would say, helping with retirement planning, and I was working under a financial advisor who was an impressive salesperson. He had basically built a $100 million book of business from scratch, just cold calling. And so the idea was, he was trying to teach me sales skills. And the idea is one day I would grow into building my own book of business. But that really never came into fruition. I think I just didn't have the gift of gab that he did. So, I kept my head down. I started studying for the CFA during evenings and weekends, and then pursued the MBA at UCLA.
Were you pursuing the MBA at the same time you were working?
Yeah, so I enrolled in the part-time evening program at UCLA, and so I'd work full-time during the days, and then my evenings and weekends were dedicated to the MBA program, and so yeah, obviously things got pretty busy.
I can imagine. How did you balance both?
Procrastination helps. Sometimes, if you only have 2 hours to get something done, you can't invest any more time than that. So
It's true. That's one way to do it. Well, it sounds like multitasking and a work ethic is something you got from your father, and I'm sure your family as well. Balancing both is quite an accomplishment. So congratulations.
Thank you.
But in 2018, you made a big big career move. So not only moving from private wealth to a public pension, but you relocated from California to Santa Fe, New Mexico. So two big decisions. How did you think about that transition, both from a personal perspective as well as a professional perspective?
I spent all this time working towards the CFA and the MBA, and in that final year of the MBA program, I ended up leaving Wedbush to do some internships and explore investment banking and private equity. And what I learned in those businesses, you have to be good at your job, you have to pick an industry and specialize in it, right? Like tech or healthcare, consumer. And it's not really what I wanted to do. I was more sort of total portfolio, holistic portfolio management. And I said, well, I spent all this time. I think I had spent altogether about seven or 8 years getting the CFA and the MBA. And the other thing in retail wealth management, you can't go to sit in a client meeting and start talking about Sharpe ratio because their eyes will glaze over. And so I said, oh, well, I have to, hide all this education if I want to be a good salesperson in the retail sector. And so, there's a saying at UCLA, diamonds polish diamonds. And my goal was, okay, where can I go where I can rub shoulders with other smart people and continue to grow. And that's sort of when the light bulb went off for me and said, okay, I need to be on the allocator side. And so when I got the offer from New Mexico, it was a perfect fit for what I wanted out of the career. And I was dating my now wife, long distance. I proposed to her, and she came out and joined me in New Mexico.
Well, that's great. Well, that's wonderful. I can keep congratulating you then throughout this podcast. So it sounds like you're on a good run. So I'm happy to hear that. Well, there were some focus areas for you when you were at New Mexico. You were responsible for core fixed income and absolute return hedge fund strategies, I'm sure, among other things. So just curious, what were some of the highlights, of the plan? What did you kind of learn as you sat in that seat, focusing on those two, relatively different asset classes? So I'm sure learning along the way, but also building along the way. So we'd love to hear some of your thoughts as to, what were the takeaways from your time with New Mexico?
Certainly, I can point to 2020 as the highlight of my time at New Mexico. When I started in 2018, I had come on as a generalist, and by the end of 2019, our CIO at the time, Dominic Garcia, offered me a promotion to build a portable alpha hedge fund program. His background, he had built the portable alpha hedge fund program at Wisconsin SWIB, and so he basically taught me everything he knew from doing that. And when COVID hit in 2020, we went full speed allocating, and so we were basically starting from zero, building a portfolio from scratch. And if you think across the industry, most allocators with a mature portfolio, they might be doing like one investment recommendation a year. I did 10 mandates in 2020. And so I just got so many reps. And I went from not knowing anything about hedge funds when I joined New Mexico to having, underwritten every single strategy type in the hedge fund business, from CTA, global macro, multi-strat, fixed income, RV, and merger arb, and it was a great experience.
Frank, we're going to spend a bulk of this conversation on your current role in North Dakota, but our audience obviously is investment sales professionals like ourselves. And touching on your prior role at New Mexico, can you give us just a little bit of insight to that underwriting process from what you recall at New Mexico? as you said, comparatively doing 10 mandates compared to other pools of capital doing one, right? That's a lot of work. I'm sure you're extremely busy, but what was that investment process? So if we do have listeners calling on New Mexico, what should they expect?
Yeah, so we did all the investment due diligence in-house and supplemented our work with the consultant reporting. And so New Mexico has a general consultant, and then they've got consultant. I think they're still using Alborn for hedge funds and real assets, and then Axia for private equity and venture capital. And so one of the other differences at New Mexico is when Dominic Garcia had come on, or prior to him joining, every investment had to go in front of the 12-person board. And when he came on, he changed that. So the investment staff got delegated authority. So it changed to we would do the underwriting, pitch our presentation or recommendation to Dominic or the CIO, and then we would give and approve it, fund it, and then we would give the board quarterly updates. But yeah, with regard to my experience underwriting hedge funds, I'd start at the Alborn Castle platform, research hedge funds, figure out what strategy I needed, who were the consistent alpha producers, and then just call on them myself.
Just one follow-on question to that. What is a typical allocation size or average ticket size, if you will, at New Mexico? Let's just take the hedge fund as an example.
Yeah, I guess in the hedge fund space, our smallest ticket size was like 40 million for higher vol strategies, and then on the upper end, I think the largest check size is probably 100 million. So yeah, 40 to 100.
Great insights. Thanks so much, Frank, for sharing those. Well, we are going to move on to your current role. We're excited to learn more about what brought you to North Dakota. And just before we do that, we are a relatively young podcast. I'm excited to say you're our first representative of a sovereign wealth fund to join the show. So to provide some context for our audience, I thought I would just give kind of a quick background on North Dakota, spare you a little bit of having to run through the mission, but we are going to be very curious as to what resonated with this mission as it related to you taking the role as CIO. So North Dakota at the time of statehood believed education for all of the children for the United States was key to creating a strong democracy. So with approval of the Enabling Act in 1889, Congress granted North Dakota the ability to become a state. The Board of University and School Lands is part of that act, and the Enabling Act provided further land grants to the state of North Dakota for the support of colleges, universities, the state capital, and other public institutions. Revenues are generated through the management of trust assets, which includes assets of 706,600 surface acres and nearly 2.6 million mineral acres. There are two constitutional funds that the money goes into, which are the Common Schools Trust Fund and the Foundation Aid Stabilization Fund for Education. The earnings from the Common School Trust Fund and the Foundation Aid dollars are transferred to the general fund, specifically to help fund K through 12 education, as I mentioned in the beginning of the podcast, which has allowed the state to increase the level of funding that is provided to the local school districts from the state to help with education funding. And I think it's notable, just to close that out, that North Dakota consistently ranks in the top 10 for public schools in the United States. So as I mentioned before, Frank, what was it about the mission of the trust lands that resonated with you prior to taking the role as Chief Investment Officer?
Obviously, that mission is wonderful, and not only for myself, but my wife is actually an elementary school teacher. So, as I was looking at the role and prepping my wife, hey, we might be moving. She didn't want to leave New Mexico. And one of the ways I sold it to her was, as you mentioned, North Dakota ranks in the top 10, and New Mexico is actually an outlier, and in the bottom, I think it's ranked 50.
I think it is too. I did look at those rankings as well. I wasn't going to call New Mexico out directly, but yes, it is. It's on the other end of the spectrum.
That was one of the ways I sold it to my wife. I said, look, wouldn't you like to work for a top 10 school district? And so she actually just accepted an offer and is going to be starting here in a couple of weeks. So she can sort of, and she also taught in California as well. So this will be her third state that she's going to be teaching in, and yeah, the mission to fund students and education resonated with both of us.
That's wonderful. I'm going to stop congratulating you, and what we're going to do is we're just going to flash a congratulations across the screen for all of this good news. So I'm happy for your wife. So please send that to her for us. Well, it's interesting because the energy sector obviously is a big part of this plan, and it continues to be at the forefront of North Dakota's economy. About half of the state's revenues and taxes come from the oil and gas industry. So as CIO, how are you going to be considering the energy sector as an investment? Just thinking about the mission, where those dollars are being generated from, both from a traditional energy perspective as well as renewables.
Yeah, obviously, the oil revenues were a great portfolio hedge for us in 2022 when, broad markets, stocks and bonds were all down. We actually had a record-breaking year on the revenue side of the business. So because of that, we actually don't allocate in the investment portfolio to energy or commodities. We do have a real assets portfolio that consists of real estate and infrastructure, and there may be some renewable energy infrastructure plays sprinkled in that infrastructure portfolio, but we don't have a dedicated energy or commodities bucket.
Well, I'm not sure if it was intentional, but it looks like New Mexico and North Dakota had a CIO swap. You had left New Mexico. Michael Shackelford joined New Mexico. And so I'm just curious, as you look at the two plans, maybe just kind of closing out, the differences between the two. What was it like working for New Mexico? What are you bringing from that plan to North Dakota, and what are some of the new initiatives that you're excited about as it relates to the coming years?
Yeah, actually, it was a coincidence. I worked with Mike Shackelford for a few months at New Mexico Para, and when I saw his seat opened up, I read the description and I thought it would be a great fit for my next career transition. Taking my perspective of now working at both plans, some of the differences are, from an investment perspective, New Mexico Para is a 10-person investment team with about 200 line items. North Dakota Trust Lands is a 2-person team with about 40 line items, and so even though and we're small, we're about a third the AUM at about $6.5 billion, and but because we're under sort of have a lower staff, we have to write bigger checks. So we're taking more concentrated positions and actually writing about the same check sizes as New Mexico. From a governance perspective, New Mexico Para is a 12-person board. North Dakota Trust Lands is a 5-person board. I find fewer chefs in the kitchen make the process more efficient. And so I do prefer the 5-person board structure. And then from a cash flow perspective, North Dakota Trust Lands is, I would say, a healthier institution than any pension in the nation. When you're dealing with being underfunded and having a liability, that you have to match to, then it's more challenging. And so the North Dakota Sovereign Wealth Fund, we don't have any liabilities. We're positive cash flowing. The biggest problem that we have that the board gripes about is how come we're not putting the cash to work fast enough. So it's a good problem to have.
That is that is an uptown problem for sure. So with two people, how are you establishing those goals and objectives? What are the priorities as you see them kind of coming in the first 7 to 8 months now and looking out maybe just over the next 7 to 8 months? I noticed that there was a headcount available, for example. I think there's an investment officer position that was posted recently.
Goals and objectives, I would say I'm looking to drive alpha across the portfolio. So, obviously you want to start with the efficient or the inefficient markets where there is alpha. So I'm looking at every part of the portfolio and then, figuring out if there's alpha in that space or not that we can chase down. And if not, in the more efficient markets where there isn't as much alpha, then we'll choose to just lever up the beta. And so we recently changed our strategic asset allocation, which incorporates a decrease to real estate, an increase to hedge funds, an increase to public credit, and allowing the use of bond leverage in public credit. And so, we do have a job posting right now that we're interviewing for an investment officer. It's a bit challenging on the hiring front because we can't just go out and say, hey, we need to grow our team, let's go hire. It actually, in the government, it has to be a bill that gets signed off by the governor in order to hire one more employee for our team. And so this year we got approved for that one more, and we launched the job ad. So we're looking for a investment officer to help us with monitoring and manager due diligence.
That's great. Well, thanks for sharing all that. I'm just curious. I know Tim's got a few questions to ask you, but on the hedge fund side, it looks like, as you had mentioned, you're going to be increasing exposure. We've heard a few of our guests over the last few months talk about equity long short, just because it looks like that the short book is starting to drive returns again. How do you see equity long short fitting into your hedge fund allocation? Is that going to be an area that you're going to be prioritizing, or are there any other areas within hedge funds that you're interested in?
You know what? I'm doing things a little bit differently this time around versus how I built the portfolio at New Mexico. When I was at New Mexico, I kind of was like, I felt like a kid in a candy store. I was like, I want one of every strategy. Give me equity long short, give me fixed income RV, and then from there, once you have a diversified portfolio of 10 strategies, that all rolls up into kind of like your own multi-strat. And but the challenge with that is, in order to push on vol, you got to then look for these higher vol directional strategies like global macro or CTA, and those strategies are always susceptible to double-digit drawdowns. Then you have to go in front of the board and defend this manager's double-digit drawdown. And so I was thinking about things differently this time around and said, hey, instead of building my own portfolio of different strategies, I'm just going to go multi-strat across the board. And so while I do think equity long short is a great strategy, I won't be allocating to any dedicated equity long short strategies. But most of the multi-strats I'll be investing in will have some kind of equity long short strategy sleeve.
Frank, you had mentioned in our prep call at North Dakota, you all are working with an investment consultant. Can you touch on that relationship and for our audience an understanding of, point of contact, right? Working with you and your team, the two folks there. Are we starting with RVK, or are we working directly with you? And how are you relying on them for investment resource and investment ideas?
RVK, they do a great job across the board helping out. We've got essentially 7 asset class buckets: public equity, private equity, public credit, private credit, hedge funds, real estate, and infrastructure. And so, I've got someone at RVK that covers every asset class, a research consultant. And so, at the end of the day, the process is, I look for strategy fit. RVK is underwriting the investment due diligence, and then once we both sort of approve a manager, then we present the recommendation to the board. And so it doesn't. I think it doesn't really matter if a manager reaches out to me first or RVK first, because at the end of the day, they got to talk to both of us. And there's certain areas where maybe I'm sort of driving more of the initial decision making, like hedge funds, because I have a background in that area. But other areas that I don't have a lot of experience in, I'm letting RVK take the lead. For example, in private credit, in making recommendations.
In obviously early days here now, you listed out a few early initiatives in areas of focus. Just touch on kind of that underwriting process and maybe the length of that underwriting process, right? Because across different channels, we have a lot of our audience covers different types of accounts, and whether it's an institution, a public plan like yourself, or even in the private wealth, the due diligence process can be quite lengthy. But touch on whether it's the speed of your work and your ability to put capital to allocate quite quickly, or does it take some time?
Yeah, it's pretty interesting because and I'll compare it again to New Mexico, where I came from. At New Mexico, they've got in-house portfolio managers that covers every asset class. So they're doing the underwriting in-house, versus we don't have that. It's me and Teresa who covers operations. So I can't put together a 40-page deck for every single manager. But so that investment due diligence and underwriting, it gets outsourced to RVK. And maybe because it's private sector, they're able to move faster. But I can push them to move faster. And so I feel like the process, sort of soup to nuts underwriting, like we can get a deal done in 2 months, and they can move pretty quick. And so RVK does the investment due diligence underwriting. And I can have and I'm doing this right now. I've got their hedge fund guys working on a multi-strat. I've got their credit guys working on distressed credit. I've got their public equity guys working on some extended equity strategies. I've got their real estate guys working on a real estate recommendation. I got their venture guys working on a venture recommendation. So we got a lot of irons in the fire right now.
No, I love hearing that. And obviously, you have quite a mix of assets. Maybe just digging deeper into the private side of things on the alternative side. I'm more curious about kind of the illiquidity or that longer lockup, right? You touched on kind of just that alpha drivers, the beta component, the public equity that RVK is working on. But on the private side, I mean, are you looking at 2, 3, 5-year lockups, or will you even go even longer, a 10-year lockup type fund structure for the plan?
Yeah, actually, and this is one of the things I really love about this portfolio that I inherited. My predecessor, had a preference for open-ended structures, as do I, and so if you include real estate and hedge funds, you can consider our portfolio 45% alternatives, but only less than 5% of that is in closed-end funds. And so we've got 80% of the portfolio has quarterly liquidity. And so I guess with that said, I'm not against closed-end structures. I have a preference for open-end, but there's certain areas where I think you got to go closed-end. For example, venture capital. unless you know of an open-ended venture capital fund.
I think since you joined, you just invested in the plan's first venture capital strategy. What was that process like? If you think about kind of everything you just shared with us, that things can take as short as 2 months. You've got your consultant in a lot of different areas of the portfolio, but maybe just looking at one recent example. So could you take us through that venture capital allocation? What did that process look like for you? And and this is a little bit of a step back, but just strategically thinking about your role. You have to direct RVK to look at all of these different asset classes. What's the work that you're doing before making that call? So maybe kind of putting it all into the context of VC. I think that'd be really helpful for our audience.
Yeah, it's really portfolio fit. So at the highest level, VC falls in our private equity bucket. We have a 8% target to private equity. We're 5% committed and only 1% in the ground. So that's been an area of focus because right now, private equity, obviously, private equity has been pretty slow to call capital, and that's been a sticking point for our board. They're, every meeting they're like, how come they're not calling capital? How come they're not calling capital? Let's get more money to work. And, they're anxious to get money in the ground in private equity. And I looked at the book, even when I was interviewing and I was studying the book. That was one area where I was like, wow, they don't have a venture portfolio. I'd love to build that out. And so when I got on, I started talking with RVK to think about, okay, how could we build a dedicated venture book, that fits in our private equity book. And they, we agreed that, venture could be about up to a third of the private equity book. And they had already put together a pacing plan in the private equity book before I joined of about $110 million a year. And so we thought, okay, if a third of that is venture, I can pace at like $35 million a year for venture. And then the question was, okay, how do I want to think about building it out? And, so I decided I want to go with a few core blue chip names, and then look for that we can go direct. And the venture industry, I think, is going through a shift right now where traditionally venture firms weren't interested in working with governments because of the FOIA, Public Records Disclosure Act, and so they were mostly working with endowments. But now that these big, most popular names are raising more and more capital, there's been this shift where now they're starting to work with governments. And so I think I came on at the right time to build this out where, valuation multiples have come down. We can get access to blue chip names. And so, my plan is I want to get access to go direct to like maybe 3 blue chip names, to build out this core. And then I'll probably have to tap into a fund of funds, to then I'll look to build out like a seed portfolio of maybe a dozen seed names. And that's where, again, our operational manpower precludes us from really going direct because I don't have the capability to write like a dozen $5 million checks. So I'm going to need to go the fund of funds route to get help with that.
That makes a lot of sense. That's great context. Thanks for sharing that. Well, I wouldn't want you to leave without asking a couple questions about the economy and just how it relates to the plan. I should ask this in the past tense now because things have changed quite a bit as it relates to investors' bond portfolios. But the Fed's interest rate increases had created this level of uncertainty in the capital markets, and consequently, we've been hearing from a lot of our guests that they've been focusing on bonds for the first time in a long time in their portfolio. But I'm just curious, from your perspective, coming into the seat, what does, and having, a background in fixed income coming from New Mexico, what are the, I guess, anticipated changes, if any, with your fixed income portfolio and maybe some of the other areas of focus? You had mentioned a few earlier priorities, but we'd love to hear some more detail for our fixed income asset managers listening in.
So one of the sticking points with our board before I came on, when we were in the low rate environment, was they didn't want money sitting in cash. They wanted to get that money to work. And now that sort of, is getting flipped on its head with, cash paying, 5%. And so I don't, I don't mind having money just sitting in cash right now, because it's just the risk reward trade off just makes a lot of sense. And so, but with regard to bonds, I just went to the board and got approval to allow bond leverage, and I hired an overlay manager who can help us get synthetic exposure to the U.S. ag, and I don't know if we're not planning to turn it on right away, right now, in this sort of inverted yield curve environment, where our borrowing costs are probably more than our expected return. We're probably going to wait it out here. I don't know really how long. I can't time it, but I wanted to get that set up. That way, when the time is right, we can turn it on. And so, yeah, we've all that to say we increase in our new strategic asset allocation. We increased our public bonds from a 5% target to a 15% target, with the allowance of a 5% leverage.
Interesting. Thanks for sharing. How about on the public equity side? U.S. equity markets seem to be continuing to be driven by a handful of tech companies, which we're all very well aware of. But we've also had a lot of investors talking to us about non-U.S. equity exposure. So developed international equities, emerging market equities, publicly traded, that is. So just curious about how you're thinking about the U.S. versus the non-U.S. Equity allocation, and if there's any work on the horizon for you in that context.
Yeah, I guess this sort of rally back makes me worry. It looks like I'm skeptical. It looks like a double top, and because when you look at the I feel like households and companies are burning through their savings, and I'm thinking, the defaults are coming down the pipeline, but then the counter argument, the saying goes, bull markets climb a wall of worry, and that's exactly why I don't want to take a tactical approach and try to make a bet one way or the other. I just want to stick to my strategic asset allocation and do no harm. But with all that said, I'm looking at extended equities, 130-30 strategies to drive alpha, whether we're going into a bull market or a bear market, lifting the constraint on that short side and allowing the managers to go short to drive alpha in our public equity portfolio, I think is a great way to do it. And so then, when you think about where's the best pools to fish for alpha, it's the small caps, it's the emerging markets, and so that's what I'm going to be looking at, hiring extended 130-30 extended equity strategies in small cap and emerging markets.
Frank, you touched on a number of asset classes that I'm sure our audience are probably getting excited about, sending you emails or phone calls immediately. So you might get flooded with that, which is good. Hopefully you could present an idea that maybe you might not have come across in your own work. But kind of the golden question as a fundraiser, we all like to hear the answer to, right, is more near-term opportunities just from an allocation standpoint. Any specific or searches currently or kind of ongoing pacing opportunities that you have in the next 6 to 9 months?
I've got a distressed credit play in the pipeline right now. I've got a multi-strat hedge fund in the pipeline. I'm restructuring my real estate portfolio right now. And then, we're still underweight private equity. So, I've got 110 million a year, and how I'm thinking about that is probably 35 to venture, and that remainder 75 to private equity, and then we've got $120 million pacing plan in private credit, and so I probably want to do a distressed credit play this year and next year, back to back.
Well, going back to the beginning of the conversation, I can see why you were so successful in multitasking when you were getting that MBA from UCLA, because this has been an incredible initiative and in a short amount of time. And I know you've got a lot of work ahead of you as well, Frank. And we're getting close to the top of the hour. We greatly appreciate your time. We're happy to have heard all of these insights, particularly from someone who's new in the seat. It's not often that we get to speak to somebody who's been in a CIO role for less than a year and what that process is like. So for us, it's been very interesting. So one thing I always like to ask our guests as we kind of close out is, who's helped you along the way? As you think about the mentors who have guided you, who have been important in your career development, both personally, again, and professionally, we'd love to hear that. And anything you could share for our audience. We're always looking for a little help, whether it's a salesperson or another allocator.
Yeah, absolutely. I think of probably my two most recent bosses, Dominic Garcia he's now at CBRE, but I worked under him at New Mexico Para, and he taught me about portable alpha, separation of alpha and beta, thinking about thinking about fees per unit of alpha, and sort of just looking past headline fees when trying to drive alpha in the portfolio. And so I think about that on a day-to-day basis. And then in my experience at Wedbush Securities in Los Angeles, Jeff Runyon, he was a great salesperson and a great mentor. He taught me about emotional intelligence, self-awareness, and I think and I think all of that helps with my ability to communicate. I'm presenting to the board, and so I'm grateful for what he taught me.
Thank you for sharing that. We appreciate it. Well, Frank, thank you again for being here today. Congratulations on all your success. Congratulations to your family as well. It sounds like a lot of things happening, so we appreciate you taking time out of your day to speak with us and to our audience. If you want to learn more about Frank and the North Dakota Trust Lands, please visit their website at www.land.nd.gov. You can find this episode and past episodes on Spotify, Apple, Google, or your favorite podcast platform. We are also available on YouTube if you prefer to watch while you listen. If you'd like to catch up on past episodes, check out our website at dakota.com. Finally, if you like what you're hearing and seeing, please be sure to like, follow, and share these episodes. We welcome your feedback as well. Frank, thank you for joining us. We appreciate it. Tim, thank you for being here. And thank you to our audience for listening in.
Don't say good.